Well, for more on the markets, Josh,
No, go ahead. I know you were excited. You were excited.
I was excited.
Tomorrow's Fed meeting. Joining us now, Michael Green, Simplify Asset Management Chief Strategist. Michael, great to see you on set.
It's great to see you.
I guess when I read through your notes, Michael, you don't sound
Why
like
do you do that?
It's so quickly, right? You don't sound like a big fan of Jay Powell and the Fed. Not a fanboy. Here you say the Powell Fed has been a series of panics.
It really has.
What do you mean by that, Michael?
Well, in Q4 of 2018, in response to the collateral crisis, so this is very soon after Jay Powell becomes the Fed chair, ultimately takes over the role, we have the collateral crisis. He cuts interest rates despite the fact that we're experiencing very low levels of unemployment, that we've already started to see some acceleration in inflation that had begun at that point. Wages had been rising fairly significantly, and we'd seen this in response to the Trump tax cuts and the stimulus associated with that. So that was a panic in response to the collateral crisis. We then have a very understandable panic associated with COVID, followed by another panic that actually kicks in 2022 when he begins hiking interest rates at a pace that candidly didn't even give the market time to adjust itself, right? So the companies that need to refinance have not actually yet approached their maturity wall or hit the maturity wall where they would experience those higher levels of interest rates. It was just a very deep misunderstanding of the role of interest rates in controlling inflation.
People love to Monday morning quarterback the Fed, right? This is a tried and true pastime here. So I guess this brings us to now and what you think the Fed should be doing going forward.
Well, I think that's what they should be doing, what they should have done. And actually, instead of Monday morning quarterbacking, I actually was out in July of 22 pointing out we'd already broken inflation. And if you pull up monthly inflation numbers, particularly on the PCE side, you discover that this inflation on an elevated, continuous basis above kind of 3% stopped in July of 2022. So everything post the Russian invasion of Ukraine has largely been within the range of historical normalcy. What we have today is we have a situation in which, because very slow-moving components that are mechanically designed to be slow-moving, things like owner's equivalent rent, where you're incorporating a series of 6-month rental pools to capture the data associated with the housing market, because you've actually treated that as effectively that the map becomes the territory, right? The numbers are right, not what we're actually experiencing in the economy. The Fed is way late to this process of cutting interest rates. We're seeing this in terms of rising consumer stress. We're seeing this in rising delinquencies, particularly for those of the lower strata of the income percentiles. And on the flip side of that equation, we're actually seeing households that are older, that have accumulated resources. They're suddenly blessed with an extraordinary amount of interest income that is sustaining everything from cruise lines to happy hour early dinners at Howard Johnson's, which I no longer really exists. So we're actually very much in a situation where the Fed has created an animal that it now needs to figure out how to address as well. My hunch is we're going to see another panic.
So those are your thoughts broadly on the Fed and the economy. But for viewers who are listening right, Michael, and they're invested in the stock market, what's your advice?
Well, I think that there's two separate components. So one is remember what actually happens in 2022. The Fed begins hiking interest rates. That hits the bond market. That flows through to the stock market, not because people are suddenly doing discounted cash flow analysis and saying, hey, maybe Microsoft is worth less. What it's actually doing is lowering the value of their bond portfolios. Because it lowers the value of their bond portfolios, they then have to sell equities, buy bonds to keep a fixed allocation. This is how things like target date funds work. So we can very clearly see that that's ultimately what played through. The minute we were done with that interest rate hiking cycle, the minute we stopped hitting bond prices, equity prices began to recover. And today we see valuations at the same levels that we saw going into those events. The level of interest rates has had no impact whatsoever. Now the Fed, of course, is turning around and saying, hey, what happens if we begin to cut interest rates? We can't do this, right? Because that'll send asset prices even higher. Well, it didn't affect it on the way up. I think it's unlikely to affect it on the way down. And if anything, those interest rate cuts could very much actually be a trigger for reduced income in that segment of the economy that has continued to spend. And so you just want to be really cautious in thinking that this is ultimately going to be some big asset boom that plays through. We saw the same thing in 2000. We saw the same thing in 2008. By the time the Fed gets to the point where it's aggressively cutting rates, it's probably too late.
Michael, I would love to keep talking, but we got to go because Microsoft is out. But thank you so much for coming in. Really appreciate it.